Good morning. Monday, September 22nd. I'm Zach Howard, and we are back with another week of markets. And to start the week, I want to talk about three things. First off is U.S. tariffs, another form of tax. Two, Japan, a Bank of Japan monetary policy as it relates to other Western economies and markets, particularly tying that back into the same theme of debasement, gold, and equities at all-time high, and what we're looking to start the week in markets from a macro trend standpoint, and what are the strongest trends out there. Let's start off with tariffs. The political cover tariffs now pose for the U.S. with its $37 trillion in debt and rising is significant and will not be going away anytime soon now that this is actually working as a source of revenue for the government. The Doge cuts and other austerity measures not really on the table. So the revenue, whether that is through capital gains, debasement, or just taking it from other countries to want to do business with the U.S., is the reality. But on an annualized basis here now, we're looking at $350 billion coming into the U.S. Treasury via these metrics. Eventually, the consumer, countries, and companies will have to eat this tax. They will not be able to pass it along. Someone always had to eat. There's no free lunch. Interesting podcast to listen to over the weekend, estimating that if you exclude those 7 to 10 big mega cap stocks in the 499, 500, and SP 500, we're looking at an impact of about 5% nominal on earnings growth going forward as a result of the tariffs. But U.S. tariff revenue coming in to the pockets of the Treasury, now they can redistribute this back in the form of checks like the COVID checks during 2020. They'll probably do it all over again in 2026 if there is any downturn from an economic standpoint, and it will be disguised to you as a good thing. But tariffs are a tax, and they will eventually come back around as inflation to the consumer, to customers, etc. There's no free lunch, like I say. Goods sector inflation now reaccelerating. Service sector inflation not going down as we are into the easing cycle, as we are into the next stage of debasement, which is further tailwind for inflation. Even if you look through the metrics of the BLS, the Bureau of Labor Statistics, and their historic Keynesian policies of measuring inflation, which we know are not real world inflation, over 72% of those components are now saying above 2%. As I talked about last week, the 2% target for inflation by central banks no longer exists. 3% is a new 2%, a 50% increase, and we are off into the races. Do we get a redo of the 1970s when Arthur Burns stopped increasing interest rates and started the cutting again, potentially setting up for the next big round of inflationary shocks that we've seen back in 2021, 2022. From all accounts, the government, the central bank are joined at the hip. They are going to run it fiscally hot, which means a bid into equities, which means a bid into hard assets. But the result is a loss in purchasing power of the citizens don't hold assets. The weaker fiat currency value will continue to accelerate. Let's look at Japan for the poster child of that. Japan and its Frankenstein monetary policies are well ahead of the West for well over a decade here with negative interest rate policies, but even more extreme, quantitative easing, buying of market instruments, whether that's bonds or even the stock market through ETFs in Japan, through real estate ETFs. The Bank of Japan holds 79.5 trillion of yen in ETFs in market value and roughly 2% of the REIT market through their purchases over the last few years. Missed in the headlines last week, perhaps, through the Bank of Canada cuts, through this Federal Reserve cuts, is the Bank of Japan did not cut. 0.5% policy stance continues, but they indicated that they want to start unloading this book. They want to start selling some of these holdings to a secondary real buyer. Who is that buyer? It would take them 100 years at this pace to unload the holdings if there was actually a willing buyer of this paper, of the Japanese yen, the poster child for it all. Looking at the bubble of the stock market in the U.S., let's look back to George Soros' great book here, The Alchemy of Finance, written in 1987. If you read this book, You didn't see the dates, so much of it lines up with today because the themes continue to be the same, cycle after cycle, decade after decade. Just the actors in the whole game change and the magnitude of it does. But Sorrell's reflexivity thesis is when you see a bubble, you want to pile in and get long of it. You don't want to fight it based on rational in your head. If we're looking through the NASDAQ back during the dot-com era, 1994, Netscape Navigator gets introduced. 2022, ChatGPT gets introduced. We are on this projected timeline. Can it go much higher? Absolutely. But let's look at where the NASDAQ is. 30.8 trillion in fiat market cap value here in 2025, roughly 105% of US GDP. Previous during the dot-com bubble, the stock market was just 70% of US GDP. The stock market, as Luke Roman has talked about for a couple of years, is of national security because of the wealth that is impounded in that equity market. Same with the S&P 500. But if we turn off our blinders to the monetary illusion that all this fiat money madness creates through number go up and look at it from something that is truth serum, gold, is it really that great? This is a chart of gold versus the S&P over the last 5 years. Gold roughly staying in nominal terms, the same return, up 42% here in 2025, hitting another all-time high to start the week in fiat dollar value, making a run perhaps towards 3,800 an ounce here in September. Pretty amazing run, but it is a product of that debasement of the real fiat value, which the purchasing power continues to follow. We look at the S&P 500, forget the 6666 magic nominal fiat number that flashes on CNBC and all the business channels nonstop 24 hours a day. It is just roughly 1.82 ounces of gold to buy the S&P 500. That hasn't gone anywhere in 5 years. The nominal number has gone up, but actually the fiat converted to gold ounces, no real return in real basis. Gold is the truth serum to all this monetary illusion. As I say, the everything bubble. We are looking at the denominator. If you devalue the denominator, number go up. That is the reality, especially with the extreme concentration in those 7, 8 stocks, which further gives you that illusion of how great the S&P is, but it's on a nominal basis. It's not in a real basis. That's what you guys start looking at stuff on a hard asset basis, not a monetary illusion. Big liquidations in the crypto space overnight. Bitcoin pulling back to 112. The more higher beta trades like Ethereum, Solana, even back more. Too many leverage players got over their skis here and now getting liquidated, and that has a cascading effect on the entire space, including Bitcoin, because of the correlation. It is what it is, and that's what the market currently is. Consolidation, perhaps. Bitcoin's still in a bullish trend, but I think we get a rise in volatility. These altcoins are really going to have some major pressure on them and see more forced liquidations. The market cap now for total crypto space below 4 trillion. On the macro front, to start the week, not a lot happening. Manufacturing PMIs in the U.S. tomorrow, new home sales, durable good orders. We're going to see if that continues to be a strong leading indicator for where the macro forecast is. Lagging indicator, Q2 GDP, not really interested in that. Core PCE as it relates to even the BLS's CPI on Friday, something to keep in mind. From my notebook, the daily notebook to start the week here, strongest signals continue to be not fighting this trade in the S&P or the NASDAQ. Higher lows, higher highs each day, bullish trend. Tesla, actually the strongest signal in those Mag 7 stocks, Mag 8, whatever you want to lump it in there. But the global macro strongest signal continues to be gold, higher lows, as I mentioned, and the GDX down here, silver. Those three continue to be the strongest. Outside of Tesla, Google looks good as well. That's what I got for you today. Have a good one. I'll talk to you soon.